Hi, everybody, and welcome back to FANG Friday. This is Ross Healy, the chairman of Strategic Analysis Corporation and a senior portfolio manager at McNichol and Associates Asset Management. Well, I hope that this isn't the first time that you've seen me this week. On Tuesday, I was on BNN talking about markets and Canadian banks. If you missed it, you can watch it by clicking the link in the description. Now, on to the FANGs. Well, we all know what was the most significant event of the week, and that was the superb quarterly report from NVIDIA, showing strong sales and earnings growth, and by extension, a reaffirmation of the AI trend. Having said that, it is mildly curious that that reaffirmation did not do more to strengthen the price trends of Alphabet and Microsoft, but it may well be early days. I do have to point out that with all the earnings now in the first quarter, the FANGs, save for Tesla, came through with flying colors, and optimism is showing a nice rebound today. In a broader sense, what this means is that the SVA methodology has maintained its buy ratings on every one of the FANG stocks, except for Tesla, which is still a sell in my books at any rate. As I observed last week, if there is a buy hold on 7 of the 8 FANGs, then I think you know what this must imply for the market as a whole, meaning the NASDAQ 100 and the Standard & Poor's 500. The FANGs are not going to keep rising on their own without company. So, for any bears that may be looking for a market sell-off, the market appears to be loudly telling us that one is not coming today, this week, and maybe and probably not for a while. Anyway, let's take a close look at the FANGs and what went on this past week. And as always, before I do like to say thanks to everyone who likes this video and all our subscribers. It really helps to grow this channel, and we appreciate it greatly. And if you'd like to know more about our valuation service, go to www.strategicanalysis.ca. Okay, as financial markets are now largely done with earnings for the first quarter, here is a look back at how the Magnificent Seven, plus Netflix, have performed and what to expect for the rest of the year. NVIDIA just crushed first quarter expectations with earnings per share, I think, of $6.12 and revenues of more than 26 billion. For the second quarter, the semiconductor giant expects revenues of 25 billion, plus or minus a couple of percent, higher than analysts' estimates. It's already announced a 10-for-1 stock split. Now, it's effective June the 7th, rather, but note, it's already been factored into our charts. So if you're surprised at a price of $103.80 for NVIDIA when it's up over 1,000, that's the reason. Alphabet delivered a beat on top line and bottom line as well, and the shares, of course, had a nice surge as a result of that, and has led to the company's first dividend. It's heading up towards its bubble price at 7.4 times book value, as I've shown you before. That is the previous high of about 3 years ago, and it's going to be interesting to see what happens then. But look at that, there's a nice uptick in the earnings forecast, and therefore our fair market value. Promising. Microsoft, they achieved quarterly per share earnings and a revenue beat. The company expects sales between 63.5 and 64.5 billion for the coming quarter. And that's pretty much in line with street estimates. Probably explains why the company's shares aren't surging, but with those kinds of numbers, they're hanging in pretty nicely, just short of the HB2, which is 12 times book. Now, Apple. Apple delivered top and bottom line beat for its quarterly results, driven by record service revenues. However, we have to say that the company's iPad and wearables business saw weakness, declining 17% and 9.6% respectively. Analysts had expected a little bit better, but who cares? The buyback is what is very clear in everybody's mind. And look at this, if I just lay this along here, you can see that the shares, assuming that slope in the last quarter there will actually flatten out, looks like the stock may be breaking out. Amazon's first quarter was 98 cents, and its revenue was over 143 billion, easily soared past analyst estimates. Wall Street believed that Amazon's quarterly results were indicative that any headwinds that their AWS had experienced in the past were over, guided in part by generative AI. Netflix, well, as happened, back in that late 2023, and again in the first quarter of 2020, their numbers just blew by all street estimates as estimates rose and subscriber additions jumped 16%. So no flies on this company. Now the question is, of course, can it break out over its HB2 price, which is 12 times book? It has been higher in the past. So it's getting up there. We're going to have to hold on and see. Tesla was the principal outlier in all of that good news. The electric vehicle maker missed estimates on both sales and earnings. However, the shares rallied as Elon Musk indicated that a new wave of growth was expected to be sparked by launch of autonomous vehicles and affordable models. Well, I hate to say it, but we've heard that before. Let's see. In the meantime, however, the stock is, I don't know whether I would say comfortably between its bubble price and its HB1. That's 7.4 and 9.5 times book. The problem, as I see it, and has been for a long while, is that those earnings and the fair market value keep falling steadily, and I keep wondering if the company is going to join that as well. Finally, Meta posted results which were better than what analysts had in mind. However, unfortunately, its shares set back as the guidance for the current quarter came in on the lighter side. So I guess it comes under the heading of you can't win them all. However, the shares have hung in nicely at their bubble price, 7.4 times book value on rising fair market value. So we'll be watching this very, very carefully to see whether it can hang in. Anyway, It's right there. Now, to briefly recap, I think you could clearly see from the NVIDIA chart that investors were kind of waiting to see which way to jump. The shares had held in fairly close to their HB6 price, that's 33 times book, and could have gone either way. They could have broke down in case of poor results, or reaffirming the trading channel that they are in, even to the point where they could break up and out again. As to breaking up and out, of course, we'll have to wait and see, but the stock is now within striking range. AI in the personage of NVIDIA may be booming, but what I might call the cast of supporting characters in the personages of Microsoft and Alphabet do not appear to be quite as confident. Both shares were selling off yesterday, albeit very modestly, and today's trading is what? It's up, but it's cautious. Still in all, at the risk of being picky, I would like to see NVIDIA's enthusiasm spread a little bit further. I'm pleased to see Apple turn around and start to rebound. It has some work to do to retrace its footsteps back over its HB6 price, 33 times book, but I do anticipate that if the coming share buybacks could render this point moot, if those structural breakpoints head lower once again, as the equity on the balance sheet is reduced. And axiomatically, of course, the return on equity heads higher. Again, I was disappointed to see that the latest quarter just reported that the only thing that happened was that the equity leveled out. They did not start that buyback process, and the equity per share did not decline, as must occur if the company wants its valuation to start to climb once again. However, it's early days. I remain bullish on the stock now that it has made the commitment to buy back $110 billion of its shares. But I'd like to see some hard evidence that Tim Cook is actually going to do what needs to be done. Next quarter should reveal more of his intentions. I would counsel optimistic patience. Even Tesla, with a somewhat worrisome news background, is hanging in above its bubble price, despite its sagging fair market value trend. Meta continues to look a little wobbly, but it's hung in very close to its bubble price so far. With no sell signals and everyone riding their positive channels, this continues to be a positive start to the market heading into the summer. Now, there are two things for you to keep in mind. First, subscribers to our SVA service can very easily assess the risks that they are taking when they own any stock that looks like one of these. That is, a stock that is trading well above its fair market value measure, that is speculatively priced. This issue has always been resolved in the past by the share price coming down to the fair market value, and often below. But the operative words are sooner or later. Often later, especially in bull markets. Second, however, that means that in bear markets, you'd better shoot first and ask questions later. That is, sell when you get an SVA sell signal, and then find out later why. You may not like the answer. We've already had two powerful examples of this phenomenon, Meta and Netflix, in the past 3 years. So stay tuned and never let your guard slip with speculatively valued stocks like the FANGs are today. Remember that. Allow me to observe that if you are holding other highly valued stocks, you may seriously wish to consider a subscription to our service. It may well be the cheapest insurance that you ever took out. Anyway, that's all for this week. For now, This has been Ross Healy, the chairman of Strategic Analysis Corporation and a senior portfolio manager at McNichol & Associates Asset Management, reminding you that nothing, including investing, is difficult if you have the right tools. I'll see you next week.